Victor, what's your take as to whether this is just a brief bounce or whether it's more than that and we found a real bottom?
Well, I think this feels a lot different. And why does it feel different? Well, because of most of September, we were trading with realized volatility in the single digits at 7.5%. That's ticked up. We're now double that at 14%, which still isn't, as volatile as it may feel. Long-term averages in implied volatility is right around 16%. So it is volatile. The biggest difference, I think, this time around is the hallmark of this market has been rotation. This time, I don't think you've really had a large sector come up and pick up the slack. You haven't seen rotation, so it feels a little bit more volatile.
Energy.
Yeah, I agree. Well, let's talk about energy. It's been strong here, Josh, but I think the tough part about that is only, 2.5% of the market. So energy can be strong, and it has been strong. Financials can be strong, but you're looking at a total of 14 or 15% of the overall market. And I think until you have meaningful participation with technology, even healthcare, Josh, it's been weak over the last month. Those are the top two weighted sectors in the S&P 500 overall. Both have been weak over the last month. And I think while those are underperforming, you're going to have sort of a choppy market here into the end of October. I don't know. It's a strong close. I don't know that we're out of the woods yet.
And if you look at what led today, Josh, utilities, staples, defensive stocks, are investors positioning for a slowdown here? Should you be thinking about that? Because it was all about cyclicals for a while.
Yeah, we should have a slowdown. Nobody's expectation should be 8% GDP growth being the norm. The question is, to what base rate of economic growth are we going to slow down? And I do think that there's a lot of concern. First of all, for the first time in a long time, we're seeing earnings revisions being lowered a couple of weeks in a row for Q3. It's almost never happens that in an expansion, Q3 is a lower earnings number than Q2. It's very hard to find an instance of that. So that's something that's going on right now. A lot of that, though, is still this hangover from all these, not even a hangover, current supply shocks, and just people trying to recalibrate. It's not that businesses aren't doing well. It's that they've got this new piece of the puzzle to figure out, which is what their costs are and what they will be going forward. So that is a trickier environment. I would agree. I don't think anybody's base case should be that growth is like a gimme. It's not going to be a gimme. We're going to have to fight it out company by company, sector by sector. The good news is it's not going to take long. It's about 2.5 weeks away. We're going to start getting results for this quarter. So we'll see what happens.
Victor, Sarah mentioned the rally in crypto today, 55K or so for Bitcoin. How are you playing that sector?
Well, I think, Gary Gensler and Jerome Powell over the last couple of weeks have removed a little bit of tail risk that's been hanging over this market for a long period of time by saying that neither of them have any, short-term plans to take the same path that China did with regards to crypto assets. Congress obviously still holds the trump card there, but I think you're seeing a lot of institutional players start to have renewed interest in this space. Individual investors are starting to become buyers and holders of the asset class. You're continuing to see longer and longer holding duration. And honestly, that's how you deal with volatility. If you have a volatile asset that you believe in the long term, and I'm not talking about the Dogecoins of the world, but if you believe in some of these, cryptocurrency as sort of a scarcity or protection of hard money currency, sound money currencies, if you believe in Ethereum, Cardano, Solana, and the like, and the platforms and communities that they're building, well, there's interesting technology, downstream technology impacts. There's more people that are starting to understand the technology, the communities, NFT adoption, all of that is growing around Ethereum. And I think you're seeing more buyers and holders in this asset class. It's making it more interesting for people looking for volatility. Look, this has a 94% volatility index here. So, 4 or 5 times more volatile than the overall marketplace. But I think when people are looking at, it's sort of interesting that even though you have high volatility and even with interest rates rising, you have an asset class that many people said, look, this is trading like a high beta tech stock. Well, in this type of environment where interest rates are rising, you're seeing it actually stronger, moving up to the 55,000. I think that says a lot about the current holders, and I think that says a lot about institutional participation here at 55.
Yeah, it climbs that wall of worry, but it does get hit on days where rates do spike sometimes.
It does.
Victor.
It does get hit. There's a couple of interesting plays off of this. Coinbase, for example, seems to not be able to get out of this range of 220 to 275. It had a couple of good sessions in a row. You can use the volatility that we've seen in this marketplace overall to actually sell some of that range. You go down and you sell the November 210, 205 puts, and you go to the upside, sell the 300, 305 calls. You can actually get paid off around $1.50 for every $3.50 of risk that you take just to play that range. If you're somebody who's looking to play this in the short term, obviously you can take longer term positions, longer term investing positions in the space as well, and it's arguably trading at the low end of its range.